Hey there. So, welcome to our live SaaS Academy sessions where we chat about all things SaaS and hopefully help you take your companies to the next level. And as we all know, exits can also be the next level you're looking for. So, today we're here with Dominic, Senior M&A Advisor at Flippa.com, one of the biggest marketplaces out there for buying and selling online businesses. And of course, Pavel, our own Head of M&A at saas.group. And we're talking about your B2B SaaS exit options today. Welcome, guys. It's great to see you here.
Yeah, thanks, Anna, for having me. It's a pleasure
Great
to be
here.
Sure, anytime. So before we go any further, first thing I want to remind everybody is that we're live, right? So at any time you think you have a question, just throw it into the comments and I'll read it out loud and see what you guys have to say about it. And I think we should get going with maybe a bit of a longer introductions from you guys, who you are and what you do. So Dominic, will you do the honors?
Sure. Well, I've been working in the M&A space for about 7 to 8 years now. I originally started in financial due diligence, so more of an accounting and finance background. Worked on multiple deals in the traditional M&A space with traditional businesses for a number of private equity and strategic corporate clients. Basically decided to go down the more entrepreneurial route and work closer with founders. Now kind of shifting away from, let's say, $1 billion deals and now more into the smaller side of let's say $1 to $50 million deals at Flippa, mostly focusing on SaaS businesses and mobile apps. And I'm a sell side M&A advisor. I help and advise those entrepreneurs that are looking to exit.
Perfect. Pavel?
Great. Well, very similar profile to Dominic. I also have M&A experience. I became a chartered accountant roughly 10 years ago. Since then, I spent 5.5 years in private equity, firstly looking at emerging markets and then at technology companies, predominantly in North America. And at some point, I realized that I really wanted to be part of something smaller, to actually build a business with other founders. And that initially led me to join Constellation Software roughly 4 years ago, where I spent a couple of years buying companies in North America and Europe. And then almost for the last 3 years, I have been working as a head of M&A for saas.group, trying to identify great founders all over the world and help them transition their business under a new ownership and then work with them after closing to help the companies grow faster, profitably.
And well, I have to say you're doing a great job. So let's get this going. One of the first questions that I really want to ask you guys is, what are the main reasons that you see founders exit in their companies? Dominic?
Yeah, I think for me, there's usually 3 core reasons. The first reason that I see mostly with founders is, and these are bootstrapped founders, i.e. they've used their own money to get the business to where it is today. It's because they're at a point where they've grown it from X to Y and they built something good, fantastic, but they kind of are now looking for maybe someone to take it on, make it go from Y to Z, so make it even bigger. And they sometimes feel that they're not that right person. I think the second reason is brutal honesty. They want cash, they want money. They've worked very hard on something for a number of years and they want the reward. And third common reason that I see as well is sometimes founders are just kind of not bored, but they're maybe seeing another opportunity that they would prefer to kind of look into. It's incredible with the entrepreneurs I work with, how many balls they're juggling in the air. And sometimes, they just want to reprioritize their goals. So that's for me, probably the 3 most common that I'm dealing with.
Pavel, what do you think? What are we dealing with at saas.group?
Well, I think Dominic just said it, right? There are the 3 main reasons, and maybe to give you a couple examples, there are a lot of founders that like to build companies and they really like to hustle to get their first customer, to get the dev team set up, to build a product roadmap. But once they get to 2 to 3 million AR business and see that business growing 10, 15% a year, it really no longer becomes a hassle, but just rather managing a day-to-day business. And for a lot of people also, I think going above 10, 20 people also becomes difficult because they have to manage the people issues on a day-to-day basis. And therefore, they either are looking to transfer the business to someone else with the hope that that new buyer like saas.group can take that business to the next level. But it's also important to remember that we at saas.group don't just always buy bootstrap companies, but also VC-backed companies. And there, the two scenarios that we see is that the company runs out of cash, it becomes bankrupt, and so it has to be sold to satisfy the debt. And we have executed a couple of transactions like that already. Or when founders are too ambitious about the business, they raise too much capital at a very high valuation. It is possible to end up in a situation where your business is growing. You're actually making a very good EBITDA, but even if you were to sell the company, you would still get nothing. And therefore, for them, it's kind of, should I keep doing it for no equity upside, or should I just sell, exit, and maybe start a new business?
Thank you. I think those are very good examples. But in that case, in all of these cases, is there ever really the right time to sell? Dominic, what do you think?
That's a good question. I think if I was running a business, I would sell as I'm growing rather than when I'm as fat as possible, like as big as possible as a company, because I always see that you always need to make the buyer feel like there's something on the table for them to grow. So it's a hard question, but yeah, that's my honest. I will try to be as little grey as possible. I'll be like black and white and give definitive answers. So of course, there's never the perfect right time to sell. But if I was selling a business, it would be, as I've shown like sustainable growth for like a year to 18 months, and I haven't peaked yet. It's clear that there's still room on the table for someone to buy me. But I'm not sure, Pavel, or I'm not sure, Anna, if you agree as well. But yeah, that's my view.
Yeah, well, first of all, I'm probably the wrong person to ask because I'm buying the businesses, and for us, it's always about finding the right balance between us getting a great return and the sellers getting the best outcome. But I would agree with Dominic that it's very difficult to convince the buyer that the business will grow if the business is not growing or is shrinking, and therefore, sellers should really always try to sell at the peak of the market. So when buyers have, like 2021, right, when we saw a peak of the VC market and so on, or when you are still growing, if you are flattening out, you're going to get a less of a multiple. And very often, we see bankers and advisors presenting a business that's flat, and suddenly after you buy it, it starts growing 20, 30%. And usually in such cases, the best thing that the buyer would get an earnout. So yeah, sell it at the peak and sell it while you're growing. Apart from that, I think any time is fine as long as you're not distressed, because some buyers also need to be aware that life can be very unpredictable. We have divorces, we have death of our loved ones, and events like that could trigger a need for liquidity. But unfortunately, you cannot predict these events happening.
I think just to add to sell at the peak comment is that I think it's very difficult just psychologically getting rid of your baby when it's doing so well, when it's top of the class. So I guess this is kind of another thing that we could discuss later. But well, for a lot of founders, M&A process is something absolutely new. What do you think they should educate themselves about before even starting to look for potential acquirers, and how to begin the process? Dominic?
Yeah. So I think a couple of things, actually. Again, if I put myself in the founder's shoes, I would speak to advisors. I mean, we're not, at least I don't charge by the hour. I charge on success. So it doesn't hurt to have conversations with people that deal with buyers every day and selling companies every day. I know the metrics that matter for certain types of businesses, and in SaaS, obviously. Now, I think speaking with an advisor, say, hey, what's the market doing? What are buyers wanting at the moment? What's important to them? What are the metrics that I should be focusing on? Then you can kind of really start already seeing where your business benchmarks against those metrics, and also start already massaging your performances towards those metrics. The second thing, I would talk directly to acquirers. So if you think there would be an interesting acquirer, just go directly to them and say, hey, this is me. What are you looking for? And I would also say, there's so many resources out there to kind of educate yourself. There's a lot of good podcasts that you can listen to, which often, and I'm not talking theory, to be honest, I'm talking lessons learned. So practical lessons learned from people, from exiteers, from people that have exited. So that's probably what I would do. I'd speak to an advisor. I'd speak to directly to some acquirers, what they look for as well, to validate what the advisor's saying. And then I'd also just look for plenty of free information on the internet from people that have been through it.
Okay. Pavel, what would you add?
Yeah, totally agree with Dominic. I think it's important for founders to understand that every successful serial acquirer has a very busy pipeline. At any point of time, there could be multiple acquisitions in diligence, multiple acquisitions where we're looking to issue offers. And the reason why that's important is that if you're not prepared to sell and if you don't have the right type of information, a lot of time your business will move down to the bottom of the pipe. So, make sure that you do some research. If you hire an advisor, hire the advisor that understands the SaaS. Don't hire a local banker that sells, 100-year-old newspaper businesses. Advisors that understand MRR, waterfall, the cloud hosting costs and stuff like that. And try to have everything on different schedules so that for buyers, it's very easy to review the information and give you a competitive offer instead of them trying to spend weeks and weeks digging for information. And then some point of time, everybody is busy and you kind of miss your timeline. So get ready, either prepare yourself or find external support. And I totally agree with Dominic that I think it's important to speak to more than one buyer and always ask them the question, even if you get a very good offer, just ask them, why do you like your business? Because there's so many buyers that would just buy because they can, because they have money to spend. And in my opinion, it's important to sell to someone who understands your business model, who can really help your business scale.
All right. So one of the options that founders have, and maybe arguably one of the easiest, if they want to keep focusing on their business, and well, that's something that they still should do, even if they're selling, and maybe outsource, the outreach and filtering the potential buyers, is going to a broker, right? So what would be pros and cons of this approach?
Yes. Ooh, that's a difficult question, but I guess I have to be honest, of course. So I think it's really important for founder, when they're looking to exit, to maintain the business. If there's no bigger turnoff, I think, at least for an acquirer, than while they're doing due diligence or while they're in conversations to see a downtrend. And so I think that that's really important. So by alleviating all of your non-core work to someone else makes a lot of sense. To someone competent is even more important. So I think that's where the cons can come in, because I think sometimes brokers don't have the specific knowledge of the specific company or type of industry. They don't have the contacts of the right acquirers in that particular type of industry. And in the end, you're double managing. So you may as well do it yourself, because you're always having to follow up the broker, or you're having to educate the broker on everything. Another advantage of having a broker is, they can basically filter out all the time wasters that you have. So there will be buyers out there that are looking to tire kick, looking to get the lowest offer possible, not qualified. You'd be horrified to see the amount of people I speak with that want to acquire businesses that don't even have the experience, know the process, have the money, and the amount of time that I save for founders, because they don't even have those conversations. They don't even know, I guess, the people that could potentially reach out to them, because, I basically only provide the shortlisted candidates. So I think there's that as well, the time saving in terms of who you're speaking with. That's also a pro. And of course, there's the knowledge and expertise. If you know different deal structures as an advisor. If you're a founder, you haven't been through it before. There are so many levers that you can pull as an advisor, which you have as experience in different deals, which you can that you should leverage on. And I think that's another pro as well.
Okay. So any more cons?
Oh, cons, yeah, fair. I think sometimes we can take too long, right? So, if the buyer has a request instantly, okay, you go through the broker goes to the seller, back and forth. That can take a bit of time. What are other cons? Well, sometimes we don't know the business as well as the founder, obviously, and you have someone else that's pitching it on behalf of the founder. But there are ways to mitigate that. I make sure that I prepare myself and I have a questionnaire, detailed questionnaire. I pitch it to the founder to make sure that I understand it really clearly. Yeah, I think sometimes, the broker can maybe come across less emotional and less, let's say, tied to the business and understand and have a thorough understanding of the business. So I can imagine sometimes a founder does want to be the person in control of that. So yeah, that can also be a con for sure.
Okay. Pavel, other pros and brokers?
Maybe let me start with negatives, and I want to maybe define that we are talking about kind of a good to average SaaS companies that are in 1 to 10 million in AR, because I think if you talk about brokers, it's important to have a context that sometimes there are SaaS companies that strategics would buy for 100 times AR, and I think the value of certain brokers is absolutely unquestionable. And so I think when we talk about kind of the average Sam or Katie type of deals, one of the drawbacks is that getting an advisor does not always guarantee that you'll get a higher price. And we've seen that multiple times. Sometimes it does because you have competitive tension, but sometimes market is market. And therefore, some brokers charge extremely high fees, and therefore you will just end up getting less money in the end. And secondly, I think when you do a diligence, when you have when a broker reached out to you with a target, we had situations where we were supposed to submit an offer without speaking to the management. And so brokers really try to be always at the front. And that's always a red flag, because even though the brokers are very good, very sophisticated, they understand the business, nobody really wants to talk to a broker without talking to the management, because ultimately you're going to be transacting with those people. As for the positives, I mean, we love working with brokers. We have bought a lot of companies that were sold by various people. And, the benefits are obviously that you have a highly sophisticated party between you and the founder. So when it comes to negotiating an LOI or things like, completion mechanism, working capital packs, it's much easier that you try to explain your rationale to a broker rather than to a founder who very often may hire a kind of a local tax advisor or a lawyer that does real estate deals, and therefore they really struggle to grasp the concepts. And of course, having a data room, having established Q&A process. So I feel like the value is tremendous. It's just really about, are you willing to sacrifice some of the purchase price to pay for it, and whether you feel like there will be a real upside. So if you have 50 people knocking on your doors, I think then getting broker is absolutely a must. But if you're just talking to someone and you feel like the price that you're getting is somewhat around the market, it's probably not worth getting the broker, or you get broker on a fixed commission, whereby you'll pay the fixed amount regardless of what the price is.
Okay, thank you. All right, the next question is a trick question. Dominic, you're going to love it. So another
Okay. Great. Bring it on.
Another option is, of course, listing your business on a marketplace like Flippa. So again, pros and cons. And what do you think? Are marketplaces good for every kind of business out there?
For every kind of business? Well, I wouldn't say, no. I don't think for every, you can't say for every B2B SaaS. Yeah, B2B SaaS, yes, I do think, because, and there are different ways that you can obviously put your business on for sale on Flippa, right? So you can do it anonymously. So for example, I have a $90 million B2B SaaS business right now on the marketplace, but it's completely anonymous. It's Project Orange. It's, we've got the high level metrics, right? So you can get the benefit of the inbound and you can get the benefit of the interested parties, but you're not giving away your sensitive information because they want it to be the founders want it to be a very sensitive sale. You can also, of course, have public and have your company's name on there, have them sign the NDA. I guess that having that option where you can be anonymous helps a lot and mitigates the risk of people not feeling comfortable of putting all their information on a platform, right? Because that can be a con for some people. Some people rightly are a little bit sensitive to what goes on there because competitors might see that for sale or people might steal their business idea. So yeah, I think that's important to know. I'll start with cons, like how Pavel did for brokers. Other cons I can imagine on marketplaces. Yeah, it does attract certain types of buyers. So you get, with the benefit of getting a lot of inbound interest and people that you'd never think would be interested in your business. That comes with a lot of positives because you get more interest and you get a lot of, quality buyers, but then you also get a lot of time wasters. So filtering through those, if you don't have a broker on Flipper, by the way. So I think they're probably two of the bigger cons that I see. In terms of positives, I mean, there's so many, but for me, the biggest one is having a competitive process. If you're selling your house, you want it to, I think you want it to go to market because you want to know, okay, I put it on the market. Anyone that had potential interest of being interested can make a bid for it. And therefore I'm going to get the best price for it. I think it's the same in this case. If I have a B2B SaaS business, I would put it on a platform. I'll put it privately though, because I am a bit sensitive with information, but I want to know every single possible buyer and see what offer, if there's an offer there, because I want the highest price possible. And I think, when you have a marketplace with, over 2 million registered buyers, that is the place to do it. I think other pros as well is you also get proper, good feedback from a lot of people. And for every, let's say 30 meaningful conversations you have, 25 probably say no, and they give reasons why. And it makes you reflect on your business and it makes you prepared for when you speak with the right buyer to really have good answers and just work on that element of the business. I've seen that happen many, many times. They're what I can think of right now.
Okay, Pavel, I know we bought at least one business of the marketplace. So what were the pros and cons of the process?
Yeah, I think the attractiveness of marketplace is also negatively correlated with the deal size, right? If you are only doing, 50 to say 300K AR, you really shouldn't reach out to broker. And likewise, you shouldn't speak to 2 acquirers. You should speak to 2 million acquirers, right? Which is what Flipper has on its platform. So we have so many teasers from banks in different countries in Europe where, they're selling 100K AR. People will not be able to cover their salaries. I do think it's a waste of time to use that. So marketplace is perfect for smaller size. I think there's the same logic for bigger deals. It's really about extending the reach to have as many buyers as possible. And what I like about platforms like Flip and Acquire and most recently Bupos is that they allow people to also provide proof of funds so that maybe you avoid having people that don't have any money, like for example, search fund investors. So I had a very good experience, but having said that, the company that we bought was relatively sizable, and we had a very similar experience with that platform, similar to what Dominic is actually doing. There was a info memo prepared, and the entire DD was done one-on-one with the seller. But initially, that business came to us through a platform, and perhaps if we were not registered, we would have never bought it. So I would encourage everyone to be on those platforms, engage with targets, and I would encourage sellers, especially the ones that are running, digital assets like websites, newsletters, etc., to list them there, because you'll be surprised. There are people all around the world that may want to own that asset, and by listing on the platform, you may surprisingly get an incredibly attractive price for your life's work.
Okay, thank you. Thanks. All right, so what should founders expect from the process? And most importantly, what are the red flags to look out for?
The best time to prepare selling is now, even though you don't plan on selling for maybe another 2 or 3 years. Just, get everything in order now. Get your financial hygiene in order. Get your business performance hygiene in order. Get your organizational hygiene in order. They're the three kind of components that I look at. So finance, financial hygiene, accounting, having a good monthly P&L, an accurate monthly P&L, having for business performance, having like clear metrics that you update every month on which acquirers are going to want, and organizational, and then the third, organizational hygiene. So like having a clear organizational structure with a clear overview of what people do in the business and how much time they spend on it, and really understanding it. If you have those three things, I think, and you are updating that every month, you're already ahead of the game. What you should expect from a process specifically, I think the first thing is to be organized. Once you have your organization, right, you can then have your documents in order for having a data room. So having a data room is basically a folder of information that a buyer will want to look at. From that data room and from that information, you can then build a SIM, or an advisor can write a SIM for you, which is a confidential investment memorandum. And basically, it's just a simple overview of what your business is. So, key business overview, financial, historical financial performance, financial projections, opportunities, organizational chart, and next steps. That's usually, I try and keep it as simple as possible. And then once you have those documents in order, you then go to market. And then, so going to market, whether it be listing on a platform or going with an advisor, or you as a founder reaching out to prospective acquirers, you're confidentially, so you're saying, hey, I have a business. You don't put the name in. You say, these are its key metrics. Are you open for a call? You gather those responses, and then you kind of get feedback and see, shortlist who's interesting. The way I rate interested parties is on three things. One, I get them to explain to me their specific interest in the business and the industry. Two, I ask them what experience do they have in acquiring businesses before, because that's really important. And three, I ask them for their proof of funds or source of capital to make sure they have the money for the valuation that we're expecting. You then shortlist those parties. Then you are expected to have management calls, answer questions, right, about the business, as Pavel was alluding to. Be very open, be very transparent from the beginning. It will always come out in DD if you're trying to hide things. So just be very open and honest from the beginning with with your business and your challenges you face. It's very attractive if you're open about the challenges you face from a buyer's perspective. And then the goal is to then, after those meetings that you have with interested parties, is to receive an LOI, a letter of intent. That letter of intent is non-binding. So that a letter of intent is basically them saying, hey, is a buyer saying, hey, I like your business from what I see so far. Here's a rough valuation. Here are the deal terms. This is the price I want to pay. And this is the amount of due diligence that this time period is the amount of time I want to take to do DD your business. You then accept, and then you go through DD, which is often a stressful period. And then after DD, you sign your purchase agreement, and then you transfer the asset and get the money. And then there's usually a transition period. So that's the process. Pavel, are there things that I've missed, or because I guess different acquirers have different processes, right?
Yeah, so assuming you follow Dominic advice and you prepared all the materials, I think from SaaS Group you should expect a very, very intensive due diligence process. We on average spend between 15 to 20 hours of meetings, meeting management team, the CEO, learning about the business, doing extensive Q&A, plugging into all your systems, reviewing all your data to make sure that no stone is left unturned, and also finding ways to help your business after closing and align on the value creation plan. As for the red flags, yeah, I agree with Dominic around the proof of funds. I think, everyone that wants to buy a business, they will do an outreach and they would find your name on LinkedIn or some sort of a website, right? So you get a lot of outreach from people who may have amazing website, who even may have profiles of people that went to a business school, worked at big banks, private equity firms, and software companies, but they don't have money. So I think it's always important to ask in the first call and before you agree on LOI, where does the money come from? If somebody tells you, well, we'll have investors, well, is it like committed? Is it on the balance sheet? Is it deal by deal? Is it a search fund? Do they have to get an approval? Obviously, buyer like saas.group has cash available backed by equity, free cash flow, and debt facilities, and therefore we can give you that continuity. So that's red flag number one. Red flag number two, I think, is generally anyone who is asking for an exclusivity period longer than 8 to 10 weeks, in my opinion, is a red flag, unless you have an incredibly complex business, right? If you're asking for more than 10 weeks, probably you need to raise money. That brings us to the point number one. And secondly, the red flag, if the buyer constantly is shifting the timeline, after 8 weeks, he asks for another 2 weeks, another 2 weeks. And we've heard of cases where sellers got a very good price, let's say 50 to 100% above the market. But the offer was from like a search fund and they couldn't get money to fund the deal. And so if buyers are unable to close in the timeline that they promised, and if there's no explanation why, I would simply walk away and save time.
Yeah, I think it's really important to have like key deadlines, key timelines that is written in stone. Only very freak accident should be a reason for it to go beyond that timeline, because otherwise it will keep extending and you need to always put pressure on the buyer to hit those targets. Yeah. And I also wanted to say, the checking that people have money might sound obvious, but you should always do it. Like, it took me, I was a bit naive, to be honest, when I first started in this space. It took me probably 3 to 6 months to figure that out, because I would believe people. I would think, oh, well, of course if they're spending all this time on this business, of course they got the money for it. No, they don't. Previously, in my previous roles, I would work on deals and of course they had the money. Like, it's subject to bank financing, but if they said something, you believed it pretty much. So yeah, I think that's really important, to really DD the buyer as much as they DD you.
That's a great point. I think a lot of times acquisitions are viewed as a one-way street. So it's mostly about, what does the buyer want? What does your potential acquirer want from you, and how much they are going to pay, and what they want to see on your term. Like, everything is about the buyer. So I guess I want to ask you guys about what should be the questions that you, as a founder, as a seller, should be asking the buyer. What should you expect, or maybe even demand, if you're going into this process?
Yeah, so I listed some of in the beginning of the process, I don't even open up the data room until they answer the 3 questions I asked before, which is, why are you interested in the business specifically and industry? 2, what have you acquired before in this industry? 3, source of funds proof. Where's your capital from? Later on, it depends on the deal structure, right? But if a buyer wants an earnout structure, like straight away, and depending on the earnout structure, of course, how aggressive it is. Like, I want at least 2 references of portfolio companies, and I want to speak with them, just to ask how it was. Too often in the industry, we hear of sellers getting shortchanged on gamification, and other issues when it comes to earnouts and seller financing, for that matter. So, part of my buy DD process that I do with the founder is, I'd love to hear about the great stories, and you don't have to be mean about it. It's just like, oh, I see on your website you've got these great portfolio companies. I'd love to hear from them and what their experience was. When do they have 15 minutes for a quick call? We'd love to hear from them about how great their experience was. And you can usually tell quite quickly how confident they are in sharing those. I also like to know from the buyer, like what and I do this kind of indirectly usually, but always having soft conversations, understanding what their pipeline's like, understanding what their deal flow's like, because Pavel alluded to it earlier. If you've got a buyer that's always extending their timeline, it could also be not because of money. It could also be because they're looking at other businesses as well. So you might be, you might think you're option A for them, but actually you're option C. And so I want to make sure before I go into exclusivity with a buyer, I'm their option A and I'm not C or D. So I also try and like to understand what their deal flow is like, what their conversion of LOI to closing is. I think also with my DDs of buyers is I like to make sure that I like to front load the DD as much as possible before an LOI. So I like to give them as much information as possible, so there are no surprises later on with a potential retrade or change in valuation. Because as we know, LOI is non-binding. The offer can change after that. But I want to make sure that they don't have an excuse. Oh, we didn't see this before. I want to make sure that it's clear that LOI is based on all the information that's been given, and give them as little scope to retrade later on. So there are a couple of ways that I kind of manage buyers.
All right, Pavel.
Super good question. First of all, I agree with everything Dominic said. I think if I was a seller, it's really important to understand the buyer motivations. Why do you want to buy my business? And the reason why it's important is, let's say hypothetically that you are making a kind of let's say an HR software, and you get two offers. One is from a private equity firm for 5 million, and another one is from a strategic buyer for 7 million. Some buyers will be inclined to accept the higher offer, but what if I told you that the sole intention of the strategic is to basically buy your customers, fire all your employees, and basically move the customers to their product? So in a way, they're buying the EBITDA of the AR, and the other buyer is just buying obviously the EBITDA that the business is generating today. And so if you just want to get as much cash as possible, you would go for the 7 million offer. And if you just want your business to run afterwards, and if you care about your employees, you would get the 5 million offer. So as long as you understand their intention, why are they bidding higher, right? Because if you are getting a crazy offer from someone in the market, it's higher than anybody else. First of all, you should be worried, like what are they seeing in the business, right? And then try to get an answer as to why and what drives their valuation assumption. And maybe then it becomes clear. And if you can leave with the answer, then I think you should accept a high offer.
Okay, thank you guys. All right, well, we actually came here to talk about exit options and deal structures. So going to be my next question. So what are the exit options, and what do you see founders going to go for these days?
Yeah, that's a great question. I think there's at least that I can think of the top of my head now, but maybe I think of more. But for me, there's kind of 5, let's say, deal levers or deal structures. So you've got cash at close. So that's the money you get when you transfer the business. You've got seller financing, right? So that's where you basically give the buyer a loan. So rather than them paying you the money now, you say, no worries, you can pay me every month over the next 12 months at a 7% interest rate. You've got stability payments, which is kind of like an earnout, but it's basically saying if my business maintains this revenue or this EBITDA, I like to go off revenue, we'll talk about that later, then I'll get this payout. And then you've got earnouts, which is if you hit this target, you'll get this payout. If you hit this target, you'll get this payout. And then you've also got a partial exit. So they're 5 I can think of, because sometimes you might not want to exit fully. So yeah, basically what I'm seeing a lot at the moment, and I think Pavel might agree or not. But, tough. It's been tough with interest rates the last 12 to 18 months. I think a way to bridge the financing issue, external financing issue, is through seller financing. So I'm seeing that to be quite common. But again, you need commitment from the acquirer. So I see 60 to 80% cash at close, and then the remaining seller financing as a common deal structure. Of course, earnouts are always part of a deal that I'm seeing a lot at the moment, but it's really important that you have an advisor, or at least you are very critical of how those earnouts are defined in the purchase agreement. So for example, I ensure for my clients that the earnouts are based on revenue or number of customers, something very tangible, something that cannot be gamified or changed by the buyer later on. For example, if it's profit, the buyer can increase their marketing expenses or waste money on things beyond your control. Well, that will affect your potential payout. You want to be in control of your future payouts as much as possible. So earnouts, I would say, are common. And what I'm seeing now as well is partial exits, where you can't agree on a valuation. You still want some cash off the table. So the buyer, rather than if the buyer can't agree on getting all of it for X, then they'll say, okay, well, we'll pay 80% for X. And then there's a bit of equity that can be held on by the seller, which is also nice.
Pavel, anything to add to this?
Yeah, I would say very, very similar. Cash at close. Our typical deal structure is a mix of cash at close and seller financing, also called promissory notes. Right now the interest rates are obviously higher than they used to be several years ago, and I think for a lot of buyers, still to put money in the bank, in certain countries you will not be able to get the amount of interest that some of the buyers can offer. Also, same on the earnouts, but for us, what's important that we can only offer an earnout when the seller is willing to stay in the business, right? And that way we can actually mitigate the issue of Dominic said in terms of the buyer can divert the resources from the company. Obviously, if you are selling to a strategic buyer, that's a big or let's say listed company, just make sure that you put in the SPA the very specific conditions of how the earnout is calculated, exactly what Dominic said, to make sure that if the buyer loses interest in your business, they don't necessarily divert the sales force that's selling that product to somewhere else. And interestingly enough, there's a lot of litigation that the buyers can research and learn how to get around that hurdle.
All right, thank you. We actually have a question from the audience. What are the downsides of selling to a SaaS aggregator, and what should you be aware of when being approached by SaaS aggregators?
Good question.
Good question.
Pavel.
I didn't realize there were downsides, but if we assume that there are different businesses, I think SaaS aggregators of all shape and form, and there are like very different ones, right? saas.group is just one of them, although we are like one of the biggest in our category. Obviously, you usually don't get a strategic exit. Strategic exit is this exit that we read in the news on TechCrunch, where a 1 million AR business gets sold for 100 million, right? And usually, I don't want to disappoint people, but the reason why that happens is because people overpay. There's a hype in the industry and you're trying to chase the innovation, right? So those deals, according to Harvard, never make sense. So of course, you would get a more reasonable price. And there are a lot of market studies that show, SDE, EBITDA, AR multiple where aggregators would acquire. The diligence process tends to be rather detailed. I think if you're selling to a strategic that knows what they're doing, they just buy in the IP, they can perhaps do a bit less DD. So it's the time effort. Some aggregators don't have money, as I mentioned, so you have to make sure that they can afford type of deal, and don't sell for $1 at closing and 9 million seller financing. But apart from it, I can't think of anything. So perhaps over to you, Dominic.
Yeah, I would say with aggregators, there are really attractive ones to go for, non-financially, right? Because you also have to think about non-financial reasons, and there are not so good ones. So I don't want to, I think when maybe the factors that you should consider when potentially being bought by an aggregator, a SaaS aggregator, for me, again, it's DDing them. Look at their portfolio companies. Go on LinkedIn and message one of the people that got bought by them and just say, hey, are you open up for a 15-minute call? Obviously, they can't divulge confidential information and you shouldn't ask for that information and they won't tell you. But you can ask them what the process was like. How stressful was DD? Where are you now? Were the promises kept? That's I've done that many times and people were very open.
Yeah, I would just add that software aggregators by definition buy software companies, and therefore if you have a software company to sell, most likely they will be interested, right? And so my encouragement is that understand where you are in the ecosystem and what is the right aggregator. So if you've built an amazing indie hacker PLG SaaS business with self-service subscription, don't try to talk to Constellation, right? They buy vertical market software on premise, very old legacy tech stacks, right? Come to talk to saas.group. Because if you talk to Constellation, you might get a very low offer. You might think, oh, like your business is not worth as much. Well, like I said, like people would try to buy if you offer, but the question is, are you talking to the right people? And then if you want your business to flourish in the next 5 to 10 years, really talk to the people that understand digital marketing, DevOps, product ownership, product management, and make sure that you speak to the right aggregators, but of course try to speak to several just to make sure that you get the right price.
Yes,
Absolutely.
it's a great point.
All right. Okay, just a couple more questions. And first one, I wanted to ask if there is any misconception that founders actually go for. So, what do acquirers really value in business? And if there is something that founders believe that acquirers tend to really care about, but they really, really don't?
The most common one is revenue growth, but no growth in profitability. I think, of course, it depends on the business and there are edge cases and outliers, but the amount of conversations I have where someone's like, yeah, but let's go Dom at a 6x because I've grown 100% year on year. Their bottom line has declined in the last year. Then the math doesn't add up. So, it means that the business isn't scalable. It means that something's not working well. I focus on that. The growth is great, but let's focus on the cost line. And you're better off being patient for 6 months. Let's tweak it together, and then let's go to market. So that's probably for me the biggest misconception. This hype, but although I think now expectations are getting better, I think also sometimes, and I could be wrong here, by the way, so correct me if I'm wrong, but I think people often put a big emphasis on the IP and the code, and obviously it's important to have a good code and a good quality product, but I think people put a lot of emphasis on the value of the IP, which honestly, in my view, is formed on speaking with hundreds of different buyers, it doesn't really matter, to be honest, the IP that much. Of course, that the IP is what generates, a good brand and a good product and good customers, and which leads to revenue and then leads to profit. But, at the end of the day, the first thing that any buyer is going to ask for, one of the first things, is your monthly P&L, your monthly profit and loss. So, yeah.
Okay, Pavel.
Yeah, well, I feel like we're super aligned with Dominic on this call. We didn't do any
prep. Okay, we need a, yeah, we need to
saying the same thing.
More.
So
okay.
I totally agree on the IP. I think people that would talk about IP are the people who have small companies that are not growing, because you then making an argument, well, I'm not growing, but I have an IP. So if you buy me, you can grow me 5x. But obviously the founder wasn't able to do that. And that, by the way, may work if you're doing some sort of a VPN tool and then Cisco buys the IP for 20 times AR because they can just kind of do it as an add-on, right? But usually it doesn't work. And I totally agree on Dominic on growth. If you have a company that's growing 20% year over year with a 0% cash EBITDA margin, that's a terrible position to be in, because essentially you might as well not grow, and have an EBITDA margin, because like you would get a better price for such company. And SaaS is one of these industries, one of the few industries where people find it's normal not to talk about profit. In any other industry, whether it's a retail or, I don't know, garden landscaping, people focus on profit. In SaaS, they don't. And I think this is where a big mistake, because you really need to understand how is the buyer going to make money from buying and selling your company. And usually by having a profit that can be levered to raise finance, and that profit can be grown and the company can be sold for a higher price. And so, yes, unfortunately, a lot of companies that come to the market, they are growing, but they're growing very inefficiently. And I think that's something that people need to accept and then really work towards rectifying to get a higher price.
Yeah, they're good points. I think on the IP bit, I don't want to sound too insensitive, because I understand if you build something and put a lot of sweat and tears and time and hours, I value your time, right? And you're building something, and that's fantastic. Maybe if you're at that point, it's like, okay, now you need to maybe shift your mindset around the product, and maybe you really need to focus on monetization. Like now it's time to like turn on the money, and because that unfortunately, you've built this fantastic IP, you've built this fantastic product, well done. Unfortunately, that alone is not going to get you to the goal that you want, which is a nice exit for a good value. So how do we get that? Okay, now to shift your mind into more monetization mode, commercial mode, and figure out some simple ways to make your business generate more revenue, which will, if it's scalable, lead to more profit. I think it's really important to not get stuck in this IP concept, and really just think about, okay, how do we turn on the revenue streams?
All right, thank you. So I have quite a few questions, but since we're at the very end of our session, I'll just throw in one more. If
Sure.
You could guys share a hack, let's say, something that that you use to really help you evaluate the company. So I don't know, a little corner where you're looking to see if there's good growth ahead, or that's a great cultural alignment, or anything that really helps you see that, hey, that's a catch, we need to buy it.
Oh, okay. I'm gonna say the rule of 40, but maybe that's too and too common. Do we hear the rule of 40 too much? So then I can come up with
Let's
something
go,
else.
Dirk.
Okay, fine. I won't then talk about the rule of 40. That's probably been said too many times. So I get excited when really I see a million ARR more. If I've got someone if I'm about to have a call with someone for the first time, I see a million ARR more, and I see 20, even like 20% EBITDA margin. That's okay, and I see them in a real niche, like a real specific niche. Random niches, it can be whatever. But if it's in like this small little market, like then I'm getting excited. Does that answer the question? I guess it's not really a hack, but it's like the things that I look out for that I get excited about.
Okay.
Yeah, for me, I mean, you already took the rule of 40, so I'll come up with something else. I would say a combo of high net dollar retention and organic growth. Because I think if you have a sticky product, you'll have a high net dollar retention. And we see a lot of opportunities in certain ecosystems in e-commerce. I'm not going to reveal the name of the ecosystem that have high growing businesses, but they just have terrible net dollar retention. And I think they would really, really struggle to sell at a good multiple. And the reason why I mentioned growth is because there are a lot of very old legacy products out there in the market that have net dollar retention of 100% because customers either cannot move away or don't want to move away. And therefore, I think if you have a product that has a good net dollar retention, 90+% annualized, and is able to grow organically, grow new MRR year over year, that's where SaaS Group would love to get positioned. Although we are open to obviously other businesses, but I think for us, net dollar retention is like the most important thing that we look at when assessing the quality of the business that we would like to acquire.
Perfect. All right. Thank you, guys. That was really great. It was really great talking to you as always. So in case anyone wants to see how to sell in Flippa or how to sell the SaaS group directly, how to find you on LinkedIn or anywhere else, what's the best way to contact you, Dominic?
Yeah, LinkedIn. LinkedIn is the best. Dominic Sullivan. But yeah, just
I'll
very
have your link
responsive.
in the comments. So
Yeah, many thanks.
Pavel.
Many thanks. Yeah.
Same here, Pavel Prokofiev at LinkedIn or Pavel at saas.group.
Wonderful. That was easy enough. Well, thank you guys. Like I said, great stuff. Thanks so much for sharing your M&A wisdom, and happy to do it again sometime.
Yeah, I love that. Thank you for having me, Emma.
Likewise.
Sure. Anytime. And take care.